So welcome back to chapter 2. Now this is, I'm going to warn you, a bit of a longer video. We're also going to do a lot of journal entries, really get into some of that accounting stuff. So you're going to want to make sure that you have those notes printed out with you so that you can go along and practice these journal entries with us. So have your notes printed out, have your pen or pencil. You might even want a calculator with you. And then again, as we're going through, I'm going to remind you, pause the video, try the journal entry on yourself, or by yourself, and then restart the video and check your answers. So make sure that you are really engaging and participating with the content. The more that you engage, the more that you participate, the more of the content that you'll really retain, and the easier that it will be, the more of this that you will learn. But you're not going to learn it and really get it if you're just being a passive spectator of it, so to speak. So like I said, we're going to learn the rules of debits and credits. We're going to start actually writing journal entries and really get into some real accounting stuff in this video. So the first thing is, when we talk, we already know what accounts are, and we know our account categories. Now, certain accounts get increased on the left side, on the debit side of the T account, and certain accounts get increased on the right side or the credit side of the T account. So when we're talking about which side increases which account, we use the phrase normal balance. So the normal balance is just the side that increases that account. So all assets are increased on the debit side and they're decreased on the credit side. All liabilities are the opposite. They're increased on the credit side and decreased on the debit side. Capital accounts, are increased on the credit and decreased on the debit, whereas withdrawals and expenses are increased on the debit and decreased on the credit. So I'm going to let you need to fill in this kind of chart there in your notes, and then I'm going to give you a mnemonic to try to help you remember, because this is one of those things you have to know the debits and credits. If you don't learn debits and credits, if you don't learn the normal balances, then nothing else we do this entire semester is going to go right for you. So this is one of those areas where you've really got to form those fingers in your brain. You've really got to form really good, solid, strong fingers in your brain, because everything that we do is predicated off of knowing debits and credits, the normal balances. So this is the mnemonic that I give you for aid reveille. You may also use all reveille. So just personal preference of whether you want to use all reveille as in AWE. I'm going to write that up here above it. Y'all know my handwriting's not very good. All reveille or aid reveille. So just to real quickly summarize the story here, and there are lots of mnemonics for remembering normal balances. There's one about elephants eating rowdy children, which I find very disturbing, but you know, maybe that's one that makes sense to you. It doesn't really matter. Whichever one you remember and makes sense to you is the one that you should use. This is the way that I learned it way back when I took my very first accounting class. So I got my undergraduate degree from Sam Houston, go Bearcats, but my professor was an Aggie. He had gotten his degree from A&M, and this is how he learned it and how he taught it to us, and I've taught every class I've ever taught this same way. So the story goes way back when A&M was first to college and first playing football. They were out there and one of their football players got hurt, and so they carted him off and they put somebody in off the bench, and he got hurt and they carted him off, and somebody else got hurt and they carted him off, and suddenly they're down to where there's nobody on the bench, right? We've got no extra players and somebody gets hurt. So now we're down to just 10 players on the football field. So one of the students that's in the stands jumps up and runs down on the field and is like, I'll fill in. I'll be the 12th man. I will fill in and stand in for my fellow Aggies. So this is where the 12th Man Foundation comes from, which is the Alumni Association. It is why the student body stands during all of the football games. If you notice, the only time the A&M student body sits is when the the opposing team's band is playing at halftime. They symbolize their membership in the 12th man. Now, Reveille is the little dog. She's the mascot, and Reveille is the leader of the 12th man. So as a good Aggie, you pledge your allegiance to Reveille. You pledge to come to Reveille's aid should she ever need you. Now, this is not how we spell Reveille, and this is not how we spell aid, but it works for our story here, so we're going to go with it. So the aid Reveille, or all Reveille if you prefer, stands for assets, drawing, or if you prefer to call it withdrawals, then you would use all Reveille, which still makes sense. We should be in awe of Reveille. So drawings are withdrawals. And expenses all have a normal debit balance, meaning they get increased on the debit side or the left side. They get decreased on the credit side or the right side. So Reveille, the REV, stands for revenues. The O is owner's equity. So this is our capital accounts and our retained earnings accounts. And then LI is the liabilities. So revenues, capital, retained earnings, liabilities all have normal credit balances. They get increased on the right side, on the credit side. They get decreased on the debit side. So when we're doing a transaction, we'll first ask ourselves, well, what accounts are affected? What type of accounts are these? And then are they going up or down? And then we'll figure out, do we need to debit or credit this account to make it go up or down? Now let's think through this a little bit more. So we know that assets go both up and down. We get cash, we spend cash. We buy supplies, we use up supplies. We buy equipment, we may sell equipment. So assets are going to go up on the left side and down on the right side. Now, drawings and expenses only go up. Okay? They only go up. So anytime we have a withdrawal, anytime we have an expense, they have to go up, and they go up with a debit. We are never going to credit a drawing or an expense except for one time a year, and I do literally mean one time a year. I don't mean like not very often. I mean literally one time a year is all we're ever going to credit a drawing or an expense, because the owner either withdrew money or they didn't. So we're either increasing the amount of money that they withdrew, right? Or we're not, but it's not like they withdrew it and they gave it back. I mean, even if they did give it back, it would go through capital, not through withdrawals. Expenses, remember, are resources that we've used up. We either used up those resources or we didn't use them up, but we don't like unuse them up. So we're never going to decrease an expense. It's just going to go up with a debit, except for, again, that one time a year. So on the right side, liabilities are going to go both up and down. We incur debt, we pay debt off, right? So they go up with a credit and they go down on the left side with a debit. Now, revenue, remember, revenue is what we have earned from doing work. Revenue only goes up. We either did the work and earned the money or we didn't. But we don't earn the money and then somehow unearn the money. Now, somebody at this point always wants to ask, well, what if there's a sales return? Like, what if I sold a product and then the customer returns it? You're right. That is, I mean, that does affect revenue, but we still don't actually debit revenue. We don't decrease revenue when there's a sales return. We'll learn later how we deal with the sales return, but for right now, just know that we don't debit revenue. So we either earned the money or we didn't earn it, but we're never going to unearn it. So we only credit revenue. Only. There's, again, one time a year that we're going to debit revenue. With capital, either the owner invested money or they didn't. But we never decrease capital. I mean, even if the owner took out their investment, that comes through drawings, not through capital. So capital is only increased. Retained earnings technically can be decreased, and we'll talk about that later on. But here's the thing, we only actually use the retained earnings account, and I'm being serious here, 3 transactions a year, and they all occur on the same date. So when you're doing your normal day-to-day transactions, you're never thinking, oh, this might possibly be retained earnings. So this makes it a little bit easier when I'm trying to figure out, because I know if there's revenue or capital involved, I have to credit those accounts. I know if there's drawings or withdrawals or expenses involved, I have to debit those accounts. So it's really only assets and liabilities that I have to figure out, are they going up or down, and therefore do I need to debit or credit them? So again, this is just a review of the normal balances. We can see that assets, withdrawals, and expenses get increased on the debit side, the left side, and liabilities, capital, and revenues get increased on the credit side, or the right side. So again, when we look at this, since remember we subtract withdrawals and expenses, so if we were to move them over, essentially add them to each side and move them over to the left side of the equation, we have assets, withdrawals, or drawing, and expenses all have a normal debit balance on the left side, while liabilities, capital, and revenue all have that normal credit balance. They get increased on the right side. Now, this is really, really important. You need to star, highlight, triple underline this is in your notes. When you are doing an entry, the debits have to equal the credits. I'm not talking about in a specific account, okay? When you're looking at the specific account, obviously debits don't equal credits unless the balance is 0. I'm talking about when we get ready to enter a transaction, when we're going to enter a journal entry that we're going to do just on the very next slide. When we enter the journal entry, we can have more than one debit, we can have more than one credit, but the sum of the debits must equal the sum of the credits. If the debits and credits in a transaction don't equal, then the accounting equation will never balance and our balance sheet will never balance. So this is super duper important. I always say that if your debits and credits don't equal in a transaction, then the earth goes tilting off its axis and spinning out of orbit. It's really super important that those equal. So every company has their own chart of accounts. They have their own listing of what particular accounts they use and what particular names they like to use. For example, there are lots of different names for revenues. Some may call them consulting fees, some may call it service revenue, some may call it fee income or consulting income. I really don't like to use the word income with respect to revenue, but some companies do. That's a common term that's used in QuickBooks, and if you take ACNT 1311, which is our QuickBooks course from me, you'll hear me rant over and over again about how I really don't like the use of the word income to mean revenue, but it is what some people call it. So every company, again, is going to have their own chart of accounts that lists their preferred names for what they want to call it. Are they calling it salary expense or wage expense? You know, what do they want to call it? And all the accounts are numbered. So typically your assets are your 100s, or if you're a really large company and you have a lot of accounts, maybe your 1000s. Your liabilities are your 200s or 2000s. Your equity accounts, your capital, withdrawals, retained earnings are your 300s or 3,000. Your revenues are in the 4s and your expenses are in the 5s. So when we get ready to do a transaction, first of all, we're going to walk through these steps together on every single transaction that we do. But first of all, we're going to ask ourselves, what accounts are affected? And I want you to think about what specific accounts. So you don't want to just say assets, right? But specifically which assets? What accounts are affected? And then we're going to decide what categories those accounts belong to. So let's say you tell me cash is effective, and I'll say, okay, well, what type of account is cash? Well, cash is an asset. Okay, so then we need to ask ourselves, is cash going up or down in this transaction? Let's pretend cash is going up. If cash is going up, and I know cash is an asset, how do I make an asset go up? Well, assets have a normal debit balance, so they go up with a debit. And so then I know that I need to debit that account. Okay. So we're going to walk through a couple of examples here, and then I'm going to ask you to start pausing the video, try to do the journal entry yourself, and then restart the video and check your answer. So here we're told Jess Bora, who is our owner, invests $6,000 cash and $200 of computer equipment into the business. So we are always examining these transactions from the perspective of the business. We are not the owner, we are the business itself. So we're looking at it from the business. So from the business perspective, the business received $6,000 in cash, $200 of computer equipment, and then in return, they gave Jess Bora capital, right? They essentially gave him a slip of paper that says, thank you for your investment. Here's your certificate of ownership, right? So let's ask ourselves, what accounts are involved here? Well, cash is involved, computer equipment is involved, and capital will be involved. So what type of account is cash? It's an asset. What type of account is computer equipment? It's also an asset. What type of account is capital? Well, it's capital. Okay, so let's think again here. Did cash go up or down in this transaction? Remember, we're the company. So from our perspective, cash went up. The company has $6,000 in cash. So cash increased. Computer equipment also increased. The company now has $200 of computer equipment. And then capital increased because capital, remember, represents external investment. We have more investment now than we did before, so capital also increased. So let's start with cash. Cash is an asset. Assets have a normal debit balance. I'm going to write aid reveille up here at the top to remind us. So assets have a normal debit balance, so means if cash is increased, cash should be debited. Computer equipment is an asset. It increased. Assets have a normal debit balance, so computer equipment should also be debited. Capital is increasing. Capital has a normal credit balance. Capital is also, should be credited then. So in this transaction, I have 2 debits and 1 credit. 2 debits for $6,000 and $200 respectively, and then I'm going to have 1 credit that has to equal those debits. So I have to have a credit for $6,200 because that is the amount of external investment. So when I look here, I can see on the left side of the cash account, I put a debit of $6,000. On the left side of the computer equipment, I put a debit of $200. And on the right side of the capital account, I put a credit of $6,200 because that's how much investment we received. So let's look at another one. So here we're told the computer consulting firm, that's us, we are the computer consulting firm. We bought equipment for cash. We spent $500 on it. So again, I'm going to write aid reveille up here at the top. Again, I apologize, my handwriting is never very good, but it's really bad on a tablet like this. All right, so I always like to start with cash when cash is involved because intuitively we understand cash a little bit better. So we bought equipment, we spent cash. Cash had to go down. We have less cash now than we did before. Now cash is an asset, and assets have a normal debit balance. So to make the cash go down, I need to do the opposite. I need to credit the cash account. Well, since this transaction only has two accounts, if I'm crediting cash, that means by default I have to be debiting computer equipment. Okay. Every transaction has to have at least one debit and at least one credit. So if there's only two accounts and you know one of them is a credit, then the other one has to be a debit, right? But computer equipment is also an asset. In this case, I have more computer equipment than I did before. Assets have a normal debit balance, so I want to debit computer equipment and credit cash. So now I can see my T accounts, and I hope you're drawing these T accounts as we go along. And don't draw a new T account for each transaction. We want to keep all the transactions in the same T account. So I probably should have mentioned this on the earlier slide, but you may want to grab a blank sheet of paper to draw your T accounts on, so that you can kind of make them, because your cash T account is going to be really big by the time we get to the end. So now I have computer equipment that totals $700, and I only have $5,500 of cash left because I spent $500 of it. So now I'm told that I purchased computer equipment on account. This phrase on account is important here. On account means there was no money that changed hands right now. It means we told the supplier, hey, send me a bill, I'll pay you later. And the supplier agreed to this. We have already set up this agreement. So we now have a debt. We have a liability that we now owe to the supplier. They're going to send us a bill, and I'm going to have to pay this later. So I have a liability. Typically, we call this accounts payable. And accounts payable is a liability for money that we owe to our suppliers. We have an account with them. We say, hey, put it on my account, send it to me, I'll pay you later. Thus the name accounts payable. It is an account that I'm going to have to pay later. Accountants are not real creative, especially when it comes to naming things. So accounts payable went up. I have more debt now than I did before. Now remember our aid reveille here. Liabilities have a normal credit balance. So to increase accounts payable, I want to credit it. So if I'm crediting accounts payable, then by default, I have to be debiting computer equipment. I've got more equipment now than I did before. Equipment is an asset. So assets have increased. Assets have a normal debit balance. So I'm debiting computer equipment and crediting accounts payable. Now, in this transaction, and again, I hope at this point that you're going to start pausing the video, trying to work some of these out on your own, or at least think through them, talk through them, and then if you then restart the video and check your answer. So here we're told that we provided consulting services for cash, $2,000. So anytime it says like we provided consulting services, or we provided services, or we earned something, any phrase that implies that we did work, that's automatically revenue. Okay, so this is code for revenue right here. This means, hey, we've done work. And remember, according to aid reveille, anytime we have revenue, we want to automatically think credit. So I want to credit my revenue account, which I believe I was calling consulting fees. I want to credit my revenue account, consulting fees, which means that by default, I have to be debiting cash. I got cash. Cash is an asset. Assets have a normal debit balance. So I want to debit cash to show that I have more cash now than I did before. So here we've debited cash and we've credited our revenue account consulting fees. So in this transaction now we're told that we provided consulting services on account. Now we've already seen this phrase on account, and when we looked at it before, we were buying or purchasing equipment, and so we said it was accounts payable. But in this case, we're not the buyer, we are the seller. We provided services, we sold services, and the customer said, hey, put it on my account, send me a bill, I'll pay you later. So this is not an account that I'm going to have to pay in the future. This is an account, this is money that I am going to receive in the future. So this is not accounts payable. This is what we call accounts receivable. Accounts receivable is an asset. It represents the amount of money that I expect to receive in the future. Remember, an asset is an expected future benefit. I'm expecting to receive $3,000 in the future. That's definitely a benefit. So according to Aid Reveille, remember, assets have a normal debit balance. Since I am expecting to receive more money now than I was before, I want to debit accounts receivable to increase it. And then because I've done work, I've provided services, I want to credit that revenue account consulting fees. So this phrase on account can get tricky. You don't want to try to memorize on account always means accounts payable or on account always means accounts receivable, because it means both. You have to ask yourself, who are you in the transaction? If you are the seller, if you're earning revenue, then it's a receivable. So here's the way that you can remember this. Receivables, accounts receivable and revenue will go together. You'll never have a transaction where it's accounts payable and revenue. We never pay someone to let us work for them, right? So if it's revenue, then the on account means accounts receivable. If we are purchasing something, then it's accounts payable. So purchases and payables go together. Receivables and revenues go together. Now here we're told we received $900 cash from the clients for services that we previously rendered on account. So back in that previous transaction, remember, we debited accounts receivable for $900. I'm going to draw that T account kind of over here. You've already got it drawn in your notes. But remember, we debited accounts receivable for $3,000. They promised to pay us that $3,000. Now the customer has sent us a check for $900 of the $3,000 that they owe us. So what do I need to do to accounts receivable when the customer has paid us? Well, remember, accounts receivable is an asset. Assets have a normal debit balance. So if the customer has paid us, that means they owe us less money now. I want to reduce the asset. I want to credit accounts receivable to show, hey, the customer owes me less money now. So when I credit accounts receivable up here, it's going to show, oh, look, hey, the customer only owes me $2,100 now. I've reduced the amount of money that I'm expecting to receive in the future. Now, what did the customer give me? They gave me cash. Anytime I get cash, I want to increase that asset with a debit. So I'm going to debit cash to increase it. I'm going to credit accounts receivable to decrease that asset. Here we're told that we paid a salary expense of $700. So again, when we see the word, there's a few key phrases that you want to kind of get on the lookout for. Anytime we see this word paid, that automatically means, hey, we spent money, right? And remember, cash is an asset, and assets have a normal debit balance. So if I'm paying something, if I'm spending money, then that means I need to credit cash. I need to credit cash to show, hey, I have less cash now than I did before. And then the other account would be salary expense. Remember, we said earlier that expenses are always, 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 always debited. So I want to debit salary expense to increase that expense, and then I'm going to credit cash to decrease that asset. Now, again, I hope that you're trying these on your own. If not, try this one real quickly, and then we'll go over it together. So just like before, when we paid the salary expense, anytime we see the word paid, meaning we are paying money, we want to credit cash, we want to decrease cash, and then since we always, 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 always debit expenses, we want to debit rent expense. So we've increased that expense and we've decreased that asset. Now, here we got a bill for the advertising expense, but we're not going to pay it today. We're going to pay it next month. Now, I want to go ahead and record the expense because it's important, and we'll talk about this more in a later chapter. It's important that the expenses be recorded in the correct period. They're recorded in the month or the quarter or the year that they were used to generate revenue. Remember, an expense is always used to generate revenue. And so we have to match the expense with the revenue in the same time period. So I don't want to put this off and wait till next month when I pay the bill. I want to go ahead and record the bill now. So I'm going to go ahead and debit advertising expense because I always debit an expense. But instead of crediting cash, I want to credit a liability account. I want to credit a payable because I owe this money. I know that I owe it to the advertisers. So remember, liabilities have a normal credit balance, meaning they get increased on the right side or the credit side. So as I want to credit that account to increase it to show, hey, I have more debt. So I'm going to credit accounts payable, and then I'm going to debit advertising expenses. Now, I do want to make one comment as we're working through this, when we're analyzing it. I mean, we can analyze the debits first or the credits first. It doesn't matter in your analysis. You'll notice that when we've been giving the answers, the debits are always listed first. That's because when we get to where we're actually writing real journal entries, these aren't actual journal entries yet. This is just transaction analysis. But when we get to where we're actually writing real journal entries, you have to list the debits first. So this is just kind of reinforcing that habit. So here we're told that the owner, Jess Bora, withdrew cash for personal use. Remember, anytime the owner withdraws cash, that is that drawing or withdrawal account. And remember, we said that withdrawals or drawings are always debited. So I want to debit the withdrawing account. And then since they withdrew cash, I have less cash now than I did before. Cash is an asset with a normal debit balance, so I want to credit the cash account to decrease it. And so at the end now, if I look at all of my T accounts, and hopefully you have all of these on a separate page and they look like this too. So you've got all of your journal entries or all of your transactions are posted to the T accounts here. And if we were to calculate all of their balances and add them all up, what we would find is that the assets equal the liabilities plus the equity accounts. So our transaction, our equation, our accounting system is still in balance.